Hey guys, welcome back to another episode of Diamond Dividends, where we go over dividend paying stocks and why they're beneficial for long term, even if you are a low budget investor. Now today we're going to go over another one of my favorite dividend paying stocks. It was actually the first stock or dividend paying stock I ever invested into. I think it was back in September of 2019, and that's Coca-Cola. The Coca-Cola is a classic everywhere brand. They don't just sell Coke, they sell Sprite, Fanta, Minute Maid, and Smart Water. Basically the entire cooler. Most of the money comes from selling syrup to bottlers and letting them handle all the heavy lifting, and that's beneficial for maintaining constant income. It's a defensive, slow and steady compounder that's been able to pay and increase their dividends to shareholders for multiple decades. But let's see if the money behind the scenes follows suit by breaking down the 5 metrics. First, we have EPS growth, or earnings per share growth. That's the net income minus the dividends, all divided by the number of available or outstanding shares in the market. EPS shows business profitability and growth potential. So no matter what kind of investor you are, or especially in this case as a low budget investor, you want to make sure that the EPS is at least stagnant, but ideally you want it to be increasing over a given period of time. Now, over the past 10 years, Coca-Cola's annual EPS has grown from $1.60 in the beginning of 2014 to $2.47 at the end of 2023, resulting in a CAGR, or compound annual growth rate, of 5.1%. Now, despite a couple of drops, including one in 2017, they still have been able to consistently grow their net income, which benefits investors with the opportunity of higher dividend payouts and an increase in their share price. Now, when you look at a chart showing the share price growth of a stock, you're looking at the price return. Now, the total return is that, but it also includes the dividends reinvested back into the company. It may not necessarily matter how much more total return of a stock is the price return, as long as it's higher, but the higher the better. According to Seeking Alpha, the 5-year history of the price return is 44.16%, which is not bad at all. But if you reinvested those dividends over that same period of time, the total return would have you making 67, almost 68%. And according to finance charts, Coca-Cola has a 5-year total return CAGR of about 10.4%. Meaning every year for those 5 years, the total return increased by 10.4%. Having a total return that's about 24% more than the price return gives Coca-Cola the opportunity to consistently increase the payouts and dividends given to shareholders. And the more you reinvest those payouts, the more you get to reinvest, and the cycle continues. The debt to free cash flow ratio tells you how many years it would take a company to pay off all its debts using just its free cash flow, or the real cash left over after expenses and reinvestments. Typically, a healthy ratio is going to be about 1 to 2, moderate is going to be 3 to 4, anything 5 or above, it's going to be where it gets a little bit concerning for the company. I personally don't have access to a website that shows me a history of the debt to free cash flow ratio, so I calculate myself using Seeking Alpha. I get the leveraged free cash flow under the cash flow section, which is the free cash flow left after a company pays its financial obligations, and then I get the total debt from the balance sheet section and do the math from there. Now, between 2019 and 2023, their debt to free cash flow ratio dropped from 6.44 to 3.12, meaning they could pay off their debt in more than half the time over that 5-year period. There was a pretty big increase between 2021 and 2022, possibly due to a lot of spending on rebranding and marketing post-pandemic. But since then, the debt to free cash flow was able to drop a lot up until 2023, so it's always good. Investing in a company that has a free cash flow that's constantly higher than its debt is always great, and having the free cash flow constantly increase while the debt either stays the same or decreases even better. Plus, the free cash flow is directly related to this next metric, so the more you have, the better. But typically the first thing that most of us dividend investors look for in a stock is the dividend yield. But the one thing that's more important than the current dividend yield is the history of that yield, or the dividend yield CAGR. Now, the dividend year CAGR shows you how much the yield has increased over a year to year on average. And of course, you want to make sure that dividend CAGR is stagnant, or yet again, ideally increasing. Now, Coca-Cola currently has a 3% yield, meaning it pays $2.04 per year per share. And they have a 3, 5, and 10-year dividend CAGR of over 4% each, which is twice as high as the Federal Reserve's aim inflation increase of about 2%. That part is really important, especially if you're someone that wants to eventually, or is striving to live off those dividends one day, because you want to make sure that the money that you're making now is going to increase at the same or at a higher rate than the rate of increase of goods and services. The last metric is the payout ratio, which you can find by dividing the dividends per share to the earnings per share. The payout ratio shows you how much of a company's profits is given out to shareholders as dividends. And according to Investopedia.com, a healthy ratio is going to be between 40 to 60%. And according to Seeking Alpha, the current PO ratio is about 68%. And the 3 to 5 years a bit higher at over 75%. A 10-year tax cut is actually over 120%. Now it's because of the EPS drop back in 2017 due to how the Tax Cuts and Jobs Act impacted revenues of the company. It actually forced them to write down $3.6 billion. The EPS alone that year had Coca-Cola's PO ratio of over 500%, so the fact that it was able to recover since then is awesome. Now what's more awesome, or the potential to be awesome, is what you can actually do with this position if you invest whatever you can over the next 5, 10 to 20 years. Now, one thing I like to do is use my own investing situation, which is only being able to invest $30 a week to determine how much I could actually make if I invested all that into Coca-Cola over that given period of time. So using an 8% price annual increase and investing $1,560 per year or $30 a week, this is what I would get. After the first 5 years, my portfolio would start paying me $206 per year in dividends, and my portfolio would be almost $8,400, about $8,389. After 10 years, my portfolio would start paying me $481 in dividends, and it would be a little over $23,000 in a projected balance. Now, when you get to 20 years, my portfolio would start paying me $1,256 per year, and my ending value would be $83,726 potentially. That's really great, and it just shows you that no matter how much you have to invest, whether it's $30 a week, $20 a week, hell, even $5 every single week, if you invest it into a position that has the right metrics, then you could possibly make a decent amount of money over a given period of time with the combination of your overall profits and the dividends you reinvest into. But the most important part of all that gibberish I just said is the concept of time. Not waiting until you feel like you have enough money to invest, but start investing now. And if it were up to me, I wish I would have started investing years before I actually did. And I actually talk more about that in this video, of how I legit lost the opportunity of about $9,000. But if you want to see the exact amount, you're really curious why all that happened and my investing story, make sure you watch that video. It's actually a pretty cool, kind of personal one. But I appreciate you guys watching this video, and until next time, as always, take care.